Good afternoon, everybody, and welcome to our third quarter capital markets webinar. We've got an exciting event today. We're going to do a market and economic overview as we usually do, then briefly walk through a performance preview of sorts. And then after that, we've got the tech team here today, and we're going to dive into some of those key tech issues. So for those of you who don't yet know from prior quarters, my name is Jerry Guger, Investment Communications Strategist at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And I'm joined here today by Jay Wells, Managing Director of Technology and member of our US and non-US core teams. Jay joined us in 2000 from Alfred University, beginning first in the Global Strategies group, quickly moving to the Technology group where he's been ever since. Jay, welcome. And I'm also joined here today by Jake Boak, Senior Analyst within our Technology team. Jake joins us from Hobart College with an economics degree. He's been with us for nearly 15 years, prior experience in capital goods and materials, but now well over 10 years covering technology specifically. Jake, welcome, and to both of you. Happy to have you both here today. And our agenda today, again, if you missed the interlude, we're going to do a review of our market and economic overview. We're going to then do a performance preview, and then we're going to do the views of Jay and Jake on those key tech issues. For those of you who provided pre-submitted questions ahead of time, we thank you. That helps steer the discussion. We want to make sure these events are as relevant to you all as possible. And so we've grabbed some of those pre-submitted questions, especially the ones related to technology, prepared some answers that we're looking forward to sharing later on in the presentation. And lastly, and before we begin, as always, we do encourage you to submit any questions you have throughout today's event on the Q&A box on your screen. After we get through the prepared remarks, we'll open the floor for Q&A for as long as we can. And so with that, let's briefly look back on the third quarter that was. And before we get to the quarter explicitly, we do want to share, and for those of you who don't know, it had been a very calm year up until really a week or two ago. In fact, 2017 was actually a famous year. Every single month, the S&P 500 had a positive month. That was historic. You can see that on the chart here, showing that there was no 5% pullback during that year. Well, 2021 was trending in a very similar direction, but then we had a little bit of volatility unfold towards the end of the third quarter. And here we've got the S&P 500, we've got the 10-year Treasury yield, and you can see some of the events that had unfolded over the later half of the summer. And you start to see some of those DC events impact markets a little bit, certain events in China occurring. But with that, let me turn it over to you, Jay. And from your standpoint, what did you see as unfolded over the quarter?
Yeah, thanks, Jerry. So I think it's probably indicative that we've reached a little bit of a crossroads in the market. So in the year and a half after the COVID lows, the stock market and interest rates have generally trended higher. But as you alluded to, in the third quarter, stocks and interest rates traded choppier than they had. And, it basically ended up roughly where we started. So after this massive run in the market, a bounce in interest rates, and a bit of a spike of inflation, and the aforementioned extremely strong economic recovery, we think the market's coming to grips with a more uncertain outlook from here. So I think it helps to maybe take a bit of a step back and talk about where we were coming into 2020 pre-COVID. So at that time, our overview was that we were late in the economic and market cycle. I think there was ample evidence the economy was starting to slow at that point. The Fed was already starting to tighten and had been raising rates. The yield curve was inverted, which simply means that short-term interest rates are higher than long-term interest rates, which is a kind of a classic negative economic indicator. So at that time, we were starting to reduce the risk in the portfolios. And of course, we didn't have a crystal ball and foresee the pandemic was coming down the pike, but we did end up being positioned well for the recession that ultimately ensued. So when there was a COVID-induced market panic, we were ready to act. There was a flurry of activity in the accounts. I've been at the firm for a couple decades now. It was probably about the most nimble I've ever seen us be, which I'm really proud of the teams in that regard. We increased our stock weighting. It was a combination of new ideas and increasing our best existing holdings. And, kind of if you again go back to the pre-COVID time, in 2018, 2019, we had a fairly material growth tilt at that point. And we really got there kind of on a bottom-up stock selection basis. So we already owned multiple secular growth investments, things like e-commerce, online payments, which would be benefiting from the pandemic, shifting business online. So as we went through the COVID trough, we were adding COVID beneficiaries, things like hotels, food services, and the portfolio became a more balanced mix of economically sensitive and secular growth investments. And as we progress through the recovery, we've taken advantage of the price appreciation that we've seen in many of our holdings, and we've reduced our stock exposure to a more neutral level. Within that reduction in equity weightings, we've reduced economic recovery plays that were the most immediate beneficiaries, or maybe what you'd call kind of early cyclicals. Well, we've been holding on to or transitioning into later cycle plays and maybe self-help stories, if you will. A good example would be we continue to hold Hyatt within the hotel space. They're better positioned relatively in that they have higher ownership of the hotel assets and they have a favorable mix towards leisure and group travel.
Just to interject here for a moment, Jay, when I look at this chart, it really kind of forces me to think about sort of the severity of what happened in late February and early March of last year. And, I was reminiscing with my wife about it, earlier this week, and the kids were home, I was at home working full time, and it was kind of a blur, as I'm sure many of us can appreciate. And I honestly don't remember too much about that period of time, but looking at this chart, it does give you a sense of just how severe the contraction that we did endure. The S&P was down something like, 20% in about 20 or 21 days. If you went back and looked at the last 100 years, the average 20% drawdown, the average time was, I think, 190-ish days. So it really was an incredibly sharp and an incredibly painful for many contraction. But what I do remember very clearly about this period of time is just how quickly we were able to respond. Our equity weighting, almost overnight went up pretty considerably. And as you mentioned, not only did we kind of increase the number of our existing holdings, we also had our shopping list kind of ready to go. So, the tech team, or the tech group, if you will, we stepped in with complete confidence to buy a number of key holdings like Expedia, Salesforce, Disney, Charter, Adobe. So, quite a number of names. But I guess the broader point that I make here is that, as an active manager, we're able to kind of exploit what the market gives us, right? So when the world around us is in kind of full-on panic mode, I guess myself and the rest of the group, we were pretty excited about what we're seeing play out in real time. Obviously, we're in a pretty different world today. As the GIST chart shows, we've rebounded pretty considerably in a relatively short period of time. We've gone from, I guess, talking about growth plunging to the economy overheating now.
Yeah, there's a good segue there, Jake. I wanted to, throw out a quote that came from the meeting notes. I was reading from one of our sector groups, the capital goods group. So in their words, supply chains are still in shock from complete disappearance of demand, which led to supply cuts, which was then followed by an immediate return demand. And I think that, pretty simply encapsulates, what we've seen and how dramatic it was. So with the pandemic, economic activity hit a wall. People were forced to stay home and shelter in place. And companies really planned for kind of a classic prototypical recession by reducing production and slashing jobs. So they believed that this was going to be relatively long-lived as you would see in a normal recession. That said, on the demand side, we had a really sharp and unexpected recovery from the bottom. And I think there's a couple of reasons for that. One is the government responded extremely quickly with the largest stimulus program we've ever seen. And really, not only was that in the US, but that was really a global phenomenon. And then we also saw vaccines developed with unprecedented speed. So rather than the 5-10 years it might take to get a vaccine, we're closer to something around a year. So you had consumers who were flush with stimulus cash. They were no longer cooped up at home, and the economy really came roaring back. And when you have a hot economy, supply shortages, that naturally leads to inflationary pressures, which is the next subject. So for the first time in a very long time, the risks of inflation are rising, and there's actually a healthy debate out there about whether inflation is transitory or not. So in the top chart here, you can see there are many parts of the economy that are currently seeing prices rise. And you probably, if you turn on the news, if you go to the grocery store, some of the services you may be purchasing, I think this is pretty well known and recognized by your average consumer. That said, our view is that we think inflation is transitory, but we would acknowledge, and we're planning that the risks are to the upside. So why are the risks to the upside? Well, again, there was the unprecedented stimulus. So on the fiscal stimulus side, we have the government spending tremendous amounts of money in terms of sending consumers stimulus checks. There were also plans for businesses, infrastructure spending. And then on monetary stimulus, we have low interest rates, really generational lows, and the Fed has been doing kind of unconventional asset purchases as well to try to goose the economy. So we think near-term inflation proves fleeting due to multiple secular deflationary pressures that are still out there. So as to kind of run through this quickly, there's globalization, there's more open labor markets, advances in technology are deflationary. So you can buy, the same tech product is roughly a similar price each year, but is 25 to 50% better. Automation is replacing human labor with machines. And then high debt loads that we really see on a global basis are also a deflationary phenomenon. So the chart on the bottom here, you might wonder why I have a chart of memory semiconductor pricing in here. And we're going to try to work in a few things that out of tech or other industries that we think are good kind of microcosms of what we're talking about at a macro level. So to tie this to macro inflation, memory demand post-COVID was extremely strong, and it was strong before the economy recovered because consumers and businesses needed more PCs for work from home. And then with people spending more time online, with businesses having to transition online, data centers needed to have more memory capacity as well. So what happens when you see a spike in demand? Well, the memory vendors need to add capacity. And as we'll get to in a few slides down the road, there's a lag between when you start to build a semiconductor plant and when it actually comes online. And as these things often work out, you don't predict the timing exactly right. And what's happening is this supply is coming on right as PC demand is starting to roll over. And so it's kind of classic economics 101. Supply growth is growing faster than demand. And you're seeing in this chart here that prices are starting to moderate. And this is basically kind of the macroeconomic roadmap that we have right now for inflation. We think economic growth is unsustainably high. We're starting to see companies ramp up supply, whether it's kind of manufacturing production or whether it's hiring more workers. And we think that as we go forward, we're going to see a similar trend as we have with memory here, and the inflationary pressures will start to roll over.
If I can just jump in for a moment here, I just sort of wanted to, tie this back to tech and kind of share how I view this slide as a bottoms-up analyst. So with respect to inflation, and I think this is somewhat obvious from the top chart that we're showing here, we would argue that tech should hold up far better than other sectors. And just to sort of like unpack that a bit, part of this is simply because, tech has the highest margins of any sector and can withstand wage pressures and rising input costs better than sectors with lower margins, right? And then the other part of this is also because the tech sector has fairly low levels of labor intensity to begin with. It's not really like an industrial company where production or the output is tied to how many people you can put on a production line, right? But I think the more important point that I'd probably make here, for me, as an analyst covering the tech sector, I'm almost exclusively looking at companies through the lens of our profile strategy. And by definition, these are companies that are deemed to have, pricing power. And so what that means is that in an inflationary environment, these companies have, sufficient enough competitive advantage such that they're able to pass on price increases. And if you're watching, you can actually see this kind of play out in real time. The example that comes to mind for me is that Microsoft, recently announced a price increase on their Office 365 suite of products. This is the first price increase that we've seen from Microsoft on that product in more than a decade. Disney also comes to mind, having recently walked up the price of Disney Plus by, I think, 14 or 15% in Q2, I believe. So I'm sure there are others that if I sat down and thought about it for a while. But the broader message being that, if you invest in the very best companies, those with sort of durable competitive advantage, such that it manifests itself in pricing power, I don't think inflation needs to be sort of the boogeyman that it's made out to be sometimes. And then I think the last thing I'd say on this point here is that any investor worth their salt isn't going to just rest on their laurels and play defense when the economic environment isn't up and to the right. So for me, with respect to possible wage inflation, I'm asking myself as an analyst, what sort of companies are potential beneficiaries, right? Because someone's always going to benefit, even if it's on a relative sense. So as a group, Jay and myself and our team members, we spent a great deal of time talking about the automation companies and what they're doing and figuring out who's poised to benefit as kind of out of businesses rethink their levels of labor intensity. And then beyond the obvious candidates, I'd submit that, tech companies really in general, at the end of the day, they're really mostly selling efficiency as either a product or a service. So again, it sort of gets back to this point of the idea that tech, at least in a relative sense, should hold up somewhat better in an inflationary environment.
Jake, that color is fabulous. I do want to make 2 points if I can jump in real quick. One, we got a question already in from a listener asking about long-term GDP growth outlook on the prior slide. Hopefully Jay's earlier comments suffice there. And then I do want to ask you, Jay, more directly on inflation, because it is such a hot topic. Do you have any additional thoughts as far as how inflation is translating into managing the portfolios?
Yeah, it's a great question. So I think there's kind of a direct way and a more indirect way, perhaps. So more directly, we own some inflation beneficiaries. So stocks like gold miners, and then in real estate, we have single family housing REITs amongst some others. So you can think of those as sort of, classically inflation hedges. And then more indirectly, and I would argue much more impactfully, actually, is if you think about our strategies, the strategic profile, the hurdle rate strategy, what are we looking for? We're looking for companies that have pricing power and can pass through cost inflation. So those companies are going to really kind of stand the test of time in a more inflationary environment. Jake just gave some great examples on the strategic profile side of, Disney raising Disney Plus prices, or Microsoft's putting through price increases right now. That's generally the sort of thing you would expect from the strategic profiles. I'll throw out a hurdle rate example. So in energy, which is a space that we have multiple holdings, when energy prices were low, so oil and natural gas, what you see classically in a hurdle rate is when returns are low, supply comes out. Companies don't, if they're losing money, they shut things down. And then as supply gets pulled, maybe even get a little bit of kicker from demand like we are now with COVID and people driving more, traveling more, industry using more energy. You get supply and demand to rebalance, that pushes prices up. And that's exactly what we've been seeing in oil and natural gas prices now. And those, that's clearly benefited from those stocks. And you can think about that as, pricing power, inflation, et cetera. And to the second question there, I did see that question come in, and I'm hoping here on the next slide, I think I'll have a good answer for the participant who asked on economic growth. So, going forward, I think, a clear message would be economic growth is almost certain to slow from unsustainably high levels. Well, Washington's debating a spending bill. If you look at this chart here, the one certainty is fiscal stimulus, government spending is going to be less supportive going forward. We're still probably going to be running deficits, but clearly not the sort of 12% of GDP level that we've been running at recently, and that's going to be less stimulative for the economy, less support. And then on monetary policy, it's a very similar backdrop. We have interest rates that for a period of time were effectively zero. Some parts of Europe, they were even negative. So you kind of have a one-way bet on the monetary policy side as well. I mean, the Fed has pretty well telegraphed that they're going to start to taper. So really, there's just kind of more room for rates to rise and for both monetary and fiscal stimulus to be less supportive going forward. And then, additionally, I would point out, we've seen a real spike in growth here, and when consumers kind of they return to normal, businesses ramp back up, the level of that. And we had really easy comps mathematically. So you're getting this growth level that's just not sustainable. And to, again, kind of work in another one of these microcosms. I follow the advertising market globally very closely because we have some online advertising beneficiary investments in the portfolio. And this year we're expecting advertising globally to grow 20%. And there's an analog here with GDP. In a normal year, advertising would grow 4-5%, somewhere around nominal GDP. Clearly companies can't keep growing at that 20% rate when normalized GDP is something much lower. And so we think that that's gonna, the ad market's gonna normalize considerably lower than where it is now. And to maybe directly ask the participants question, our long-term GDP outlook is similar to what it was pre-COVID. We think we're going to settle back into a fairly low growth environment going forward. There's a lot of debt out there, which makes it again, it's kind of deflationary, makes it difficult to grow. A lot of the world's dealing with difficult demographics as well. So we absolutely do not believe that we have this new higher trend level of growth. We think we're just seeing a spike off the bottom, off a recession. So maybe to transition to discussing growth in the market a little bit more. We've been saying for a while that the economy is transitioning from early to mid-cycle, and that the stock market is exhibiting kind of more late cycle characteristics. So we're still finding pockets of opportunity. The teams are still generating new bottom-up investment ideas. But when you look at the stock market in general, it looks rather elevated to us. It looks maybe fairly valued at best to overvalued. And again, that's because the market has really been buoyed by all of this fiscal and monetary stimulus sloshing around out there. So if you think about government payments, that ends up in the pockets of businesses or consumers. So that drives, again, to kind of GDP growth near term, but that again, you're only got to get so much kind of near term mileage out of that stimulus. It doesn't last forever. And then additionally, financial assets, a lot of those dollars have found their way into housing or into the stock market, pushing up valuations. And then, again, we talked about generationally low interest rates. So when rates are low, that encourages borrowing, which again drives more spending. And then also it drives more ownership of stocks over bonds. It's you may have heard of the TINA phenomenon, or there is no other alternative. If you're picking up 1 or 2% in bonds, then people start to pay higher and higher multiple for equities because it's one of the few areas they can go to get any returns. So I guess something else I would work in here is, I think the speed of the market recovery in the kind of decade plus long bull market that we had prior to COVID also plays into this. So normally you would see a more protracted recession. It might be 12 to 24 months. You'd have a deeper and longer bear market than we did. And you'd get a lot of the excesses washed out. I mean, in some of the prior recessions I saw in my career, you might have a generation of investors that kind of swear off the market for a period of time because they have such a bad experience and sell out at the bottom. We really didn't see that this time around. The dip was so short-lived. And again, we had such a long bull market that investors really have been conditioned to buy the dip. They've been conditioned that they can never take enough speculative risk, right? The further they go out on the risk spectrum, stocks only go up. They're just going to make more money. So, they're buying meme stocks, SPACs, cryptocurrencies, NFTs, et cetera. And that's all indicative of an environment that unsurprisingly is, probably, a tad over ebullient at this moment. So we think investors need to be prepared for lower returns going forward. Again, stock valuations are full, and economic and earnings growth are likely to slow from here. So it's not the easy money's been made. It's not as strong a backdrop as we had 6 to 9 months ago. And you could say the same thing kind of on the fixed income side in terms of the return outlook from here. It's also challenging. Interest rates are low, so you're not picking up a ton of yield if you're purchasing fixed income here. I think that everybody knows that, and I'm probably not shocking anybody either by saying, like, look, there's a lot more room for rates to rise and fall, and if rates rise, that's negative for bond prices. So it's not a market that terribly attractive at these levels. And then finally, beyond expecting lower returns, I would just point out there, again, there are these clear pockets of speculative excess, and that's really where active management becomes more important, and we can shine for the clients and protect them on the downside. If you're out there kind of blindly buying an index or a passively managed ETF, I've run through some of these lately, and it's kind of scary. Some of the weights, like individual meme stocks, are in some of these ETFs, especially when you get into some of the smaller, more esoteric ones. So you're running the risk of getting things that have been bid up speculatively by retail investors. You're just going to get those at market weight, whereas we can avoid those. So that's just the final thing I would point out there.
No, I think that's a really good point, Jay, though, in that overall theme and the importance of active, we know we talk about a lot. We talk about in a lot of these quarters. That's the end, by the way, of our market and economic outlook. And we hope that that's a useful refresh for all of you. And we know there's a number of financial advisors on the call who are wondering our views and how they can jive with the conversation that they're having with clients. So if you have any additional questions on that, please feel free to let us know. But that theme about active management explicitly in that lower return environment, we think is so important. And to be clear, we are long-term investors, and here during this performance preview, we're going to show some shorter term numbers at the beginning because it feels like the appropriate thing to do for a quarterly call. And here in our traditional bottom-up multi-asset class portfolios, you can see performance generally in line, largely within the margin of error for what was in many ways kind of a flat quarter on both an equity and fixed income standpoint. From a traditional bottom-up asset class specific standpoint with US and non-US and then global broadly, you can see the non-US portfolio is really a standout here. Excellent positioning, strong security selection, continuing to build on a strong year and very strong recent results. For more of these results, by the way, there is an appendix at the end of this presentation, and there will at some point shortly also be a replay review as well in case you'd like to see that. In addition, we'll also share our map so you can find your appropriate contact at Manipur if you have additional questions on some of these numbers as we kind of tear through them here. From a specialized standpoint over the quarter, very modestly weak, again, within the margin of error. A bias to quality within the disciplined value strategy was the slightest bit of a headwind in our international small cap strategy. Bias away from energy was, again, the most modest of headwinds. But from a year-to-date standpoint, and again, we generally think about investing over full market cycles. And, year-to-date doesn't exactly get us all the way back to pre-pandemic, but, it helps broaden the time horizon out, which I know is so important when we're picking individual securities or just managing the portfolio from a top-down perspective. And in this case, excellent asset allocation, decision-making, and overweight equities during the earlier parts of the year when we felt like the risk-reward trade-off was more favorable has really played out in our favor. I guess with that, Jay, any additional comments you'd like to make on any of this so far?
Yeah, I'd throw out there that, you kind of mentioned it's not shown kind of from the cyclical trough post-COVID. And, that if you look at the performance since then, it's really been quite good across the various accounts. And I think it's probably an opportunity to note that we invest long-term. We're not worrying about short-term fluctuations, kind of the week by week or the quarter by quarter. We don't try to time the market. I think one of our biggest advantages, probably especially being based in Rochester, is time arbitrage and being able to take a longer view than most. And so, we're thinking about a full market cycle, so we're going to try to participate in the bull market, but to be honest, we're going to leave some performance on the table, maybe at the kind of last gasp when there's this irrational blow off to the cycle. But at the same time, the point there is we're going to protect on the downside for the clients by not taking on those kind of irrational risks. And we think that kind of that combination, putting all that together, it's the right way to add stable value.
Absolutely. And if I could add on to that too, if you strip out the asset allocation component, because so much of that kind of smoothing out the ride, I think investors tend to think of that in terms of multi-asset class solutions and managing your asset allocation. But even stripping that out, part of being a truly active manager and going security by security in the portfolio is the ability to gather and implement a lot of those same philosophies in single asset class solutions. And here you can see a longer term view of some of those select bottom up strategies. Any additional color you want to share here?
Yeah, sure. So, these accounts have been really outstanding. I think the thing I've noticed, watching them on a regular basis, that the outperformance really is built steadily coming out of COVID off the bottom. But I think more importantly, just really proud of the team here. We've had really good idea generation. It's not always easy to find non-US ideas. Just there's kind of information gaps, that sort of thing. But the team's been able to find large cap strategic profiles like a Taiwan semiconductor, maybe that are more well known. But at the same time, I think we've also been able to source some more undiscovered small to mid cap ideas like S4 Capital or Keyword Studios that we think have really phenomenal long term prospects. So I think great job there by across the board by the team.
Absolutely. And those are some of the most interesting, tangible, really value add ideas. And they're exciting to hear about. And I know that advisors and clients like to hear about them as well. And yeah, just to reinforce, really proud of the team and the job that they've done of late with all the portfolios that you can see here. Last but not least, on the specialized portfolio front, are some of these strategies, some of those headwinds that I discussed earlier, especially with the disciplined value strategy, the philosophies underpinning that, a focus on quality businesses that pay dividends, that generate cash flow, a focus on price, not wanting to pay too much. Though these are time-tested investment philosophies, the track record is the long-term track record remains excellent, and we have full faith in the strategy. And there are times where it'll be out of favor, and then there are times that there will not. And actually somewhat similar story too with the international small cap portfolio as well, whereas a growth versus value style trend has been a little bit of a headwind in that portfolio for the year. But in that case, the track record remains absolutely outstanding. So if you have any questions on any of these portfolios, the bottom up portfolios, specialized or otherwise, again, feel free to reach out. We'll share a link in the chat where you can find your representative. And so with that, I think, Jake, let's get to the tech discussion. I know that this is a part that is certainly near and dear to you guys, and we have a lot that we'd like to talk about. There's so much happening in technology right now. We got a number of questions on that. So we've taken, in this case, 6 of them, and we've pre-prepared some answers that we hope, we can share a couple charts, a few visuals that can go along with this, that can give a little more color, maybe some insights that for those advisors that are on the call that you can then share with your own end clients. So with that, I want to start with you, Jake. And the first question here, and it's so broad, but also important and all encompassing, just the notion that has the tech run gone too far? Do you think tech is in a bubble? Do you want to just kind of talk about that for a little bit?
Yeah, sure. So I think it's probably fair to say that there are some parts of the market that have exhibited some speculative excess that Jay recently commented on as well. My observation would be that sort of euphoria is somewhat confined to a pretty narrow, small corridor in the market. we're talking about almost exclusively, hyper growth companies, unprofitable companies, or companies with rather poor earnings quality. When I look at what I would consider to be some of our best companies that we own, the valuations look, fairly reasonable. In some cases, they actually look compelling, right? So, Amazon is a company that sticks out to me. We own that. It's trading at an all-time low on a relative PE. Facebook, is trading at roughly a market multiple, despite the fact that it's growing, I think 3 times faster, and it's got operating margins that are 20 points higher than the market. Salesforce is another one that kind of jumps off the page at me, trades at a pretty significant discount to its peers. So I guess what I'd say is that, look, Jay and I have been doing this for 35 or 40 years, Jay. What normally happens when the market starts to run hot is that we will have a harder time sort of justifying the valuations of our existing holdings. And we'll start to see some of our colleagues sort of move to bull case scenarios in order to hang on for the last 10 or 15%. We're just not seeing that today. And I guess to answer the last part of your question, whether we're in a bubble, while I think no 2 bubbles are the same, I think it's pretty instructive to go back and sort of look at what transpired in 99 and 2000. And I think by almost any measure you look at, the tech sector, looks far more compelling today. The valuations are significantly lower. The margins are much higher. The sector generates much more cash. The earnings quality is better. The shareholder returns are higher, and the balance sheets are in better shape. So, to answer your question directly, Jerry, no, I don't think we're in bubble territory today.
And I know there's a lot on the page here, and we don't expect you all to be able to understand everything or to be able to quickly glance and process all the data here. But the broader point remains, Jake, and I think on the prior slide too, can you just briefly mention what exactly we were showing on that chart?
Yeah, so I believe that was the trailing PE for the tech sector relative to the market, correct? Yes.
Yeah, and just highlighting the fact that valuations, and this is showing the whole time series really back through the dot-com bubble, and then the average stripping out the absolute most exuberant, I guess, stretch, would it be fair to say? And then here, just highlighting that particular measure right at the very beginning in the top left, but then so many other measures broadly. And I think that kind of dovetails with your point.
Yeah, absolutely.
All right, so the next question, and then let me send this back to you, Jake, as well. And I know this is related to the prior question, but can you talk a little about market concentration explicitly? And, I know that's primarily driven by some of the biggest tech names.
Yeah, it's certainly true that the market is now being driven by just a handful of companies. And as you cited, just, predominantly we're talking about the mega cap tech companies, right? But frankly, I don't know whether that really says anything in and of itself. It's really not obvious to me whether that's, a good thing or a bad thing. If the earnings and cash flow of these companies wasn't there, then this dynamic would sort of worry me a bit more. But if you pull up that next chart, Jerry, as you can see, that's not really the case. So, yes, more of the index's market cap is concentrated in a few companies, but there's the earnings and the cash flow there to support that, right? And so frankly, given what we know about these companies, I don't think what we're seeing should be all that big of a surprise to anybody. These platforms we're talking about, the Amazons, the Microsofts, the Facebooks, the Googles, they have just massive scale, and they're growing well above underlying market growth, right? So, Amazon is a $1.5 trillion company today, roughly. They're approaching $500 billion in revenue. And they're still growing north of 20%. So, mathematically, unless the multiples compress, and again, I just mentioned that it's at an all-time low on the relative PE, mathematically, this company has to continue to grow its share of the index market cap, given its size and the fact that it's growing twice as fast. Similar story with Facebook. Again, it's a $120 billion run rate in the top line, and it's probably going to grow more than 40% this year. Google, Microsoft, same dynamic. So these massive platforms have just been showing that they have, very sustainable above market growth. I think maybe a tangentially related question that you might want to ask, or maybe you could ask, is sort of like how much longer can this persist? Because that's really like the meat of like what I think a lot of people are wanting to know. How much larger can these companies get sort of before they hit a ceiling in terms of their penetration, right? And, I think, I guess I'd say, unless regulators say like enough is enough and these companies can't, basically do any more M&A, even in that draconian scenario, I still think that they have a great deal of wood to chop just given their existing sort of business today. So Amazon, has a 40% share of US e-commerce, but its share of retail sales in the US is closer to 3 or 4%. And on a global basis, it's less than 1%. Facebook, yes, it has 3 billion users, but its share of the total advertising and marketing spend is, I think less than 8% today. Same thing with Google, less than 10% share of kind of marketing and ad spend. So I don't feel like we're at the point yet where we need to start worrying about growth just hitting a wall.
Yeah, and to interject on that too, I would add, each year, at the end of the year, all the sector groups go back and they do an exercise where they look at kind of what went well, but also what mistakes did they make during the year, and kind of try to put in some process to get better. And one of the things that we've been trying to get better at for several years, I think, is figuring out how to buy and hold on to some of these really high growth tech companies. And one of the big lessons learned over time for us has been, if you look at the companies that are strategic profile strategy fits, where they have platform type competitive advantages, which could be, massive computing infrastructure or large customer bases, software ecosystems, or, other platform aspects, those businesses can generally enter or create new markets from a competitively advantaged position. And a lot of times, if you could just buy those companies around fair value, these platforms there's this positive optionality that's not embedded in the share prices. These companies will tack on these massive revenue streams that nobody's imaginative enough to kind of foresee. And I'll run through some examples here that hopefully kind of highlight what we're talking about with this. So maybe one of the most notable ones is Amazon, where they started off selling books online. Now, it didn't take a ton of vision to figure out that Amazon would expand into selling other categories online. But the big positive surprise, if you went back 15 years ago and you're building out a financial model on Amazon, trying to price it out, no one was building in AWS and this cloud computing business that's now a majority of their profits. And why was Amazon able to tack that on? Because they have dozens of data centers that have, in combination, millions of servers. These data centers cost $500 million to $1 billion each. So not anybody can just do this. And they were able to basically layer on this cloud computing business on top of the retail business and create tremendous value that was unanticipated. Another example would be NVIDIA with their graphic processing unit chips. So say 10 years back, if you were trying to model out NVIDIA, you'd be aware that, they have these parallel processing chips, that they have a very strong software ecosystem, not Microsoft-esque, but, if you kind of think about those lines of how Microsoft's been able to parlay its ecosystem. So they took that and they were able to basically, they found out that was ideally suited for running artificial intelligence workloads in data centers, and also doing work supporting autonomous driving. And the tremendous performance in NVIDIA over the last 3, 4, 5 years has been because they've created these additional legs of the stool, if you will, in terms of tacking on new businesses that people didn't expect. So if you can buy companies that have those sort of platform kind of inherent competitive advantages, they'll tend to surprise you on the upside long term. And it gets into the question of, how do you buy these companies here and make money on them long term, and why we think they still have a long ways to go, a lot of tailwinds behind them.
I hope that, and we got a couple questions in the chat, and we know we have a few in the Q&A. The Q&A certainly easier for us to get to, but those in the chat, I know someone had asked about certain opportunities and pockets of value. Hopefully we were able to cover some of those with the answers that Jay and Jake just gave. And again, we encourage you all to submit questions through the Q&A box so we can sort through them as best we can. But with that, I do want to change gears a little bit. And I want to talk about this idea that, hey, if we pulled forward a whole bunch of e-commerce, just broader digital transformation in general. So Jay or Jake, I don't know which one of you wants to kind of take that on first, but can you talk about that idea if we move past peak e-commerce, I think was the question explicitly.
Yeah, it's a great question. Look, on a global basis, I think it's a safe bet to say that we're still in the very early stage of the world transitioning to more of like a digital economy, if you will. This is sort of an indisputable and I guess irreversible trend, and there remains a pretty long runway of growth ahead. E-commerce is sort of just one part of that transformation, whether it be kind of business to consumer, or consumer to consumer. Consumers are migrating online, and businesses are migrating online in I guess, hanging a shingle on the internet quicker than they ever have before. Which is exactly what they should be doing, right? You kind of have to meet your customer where they are, and for a business to move online, that allows them to basically be borderless. It allows them to operate without the same sort of time and inventory constraints that a brick and mortar business has, and ultimately reach a much larger audience of buyers. I think with regards to how COVID may have impacted consumer behavior, I don't think the impact COVID has had can be overstated enough. I think there's no question that COVID has accelerated the migration of more consumer spend moving online. I think you'll see this particularly in developing economies where penetration was very low to begin with. So places like Latin America, Southeast Asia, Middle East, North Africa, they're all telling you the same story. But even in developed markets, I mean, we were sort of settled at a higher point post-COVID than we were prior to COVID. So I think this chart's interesting because admittedly, it's the first time in 2+ decades where the data shows that underlying retail sales is growing faster than e-commerce, which is pretty staggering to think about. But my contention would sort of be this is mostly about transitory phenomenon at this point. I think if you look at sort of what transpired in 2020, many physical retailers were basically forced to, shut their doors. You actually had retail sales go negative in 2Q20. E-commerce went from kind of mid-teens growth to something north of 40%. Now, if you actually unpack that a bit and look under the hood and looked at the sort of like the composition of that, you had different categories like office supplies and exercise equipment. They just, they exploded right up and to the right, just gangbusters. People were setting up home offices and home gyms. And at that point, their only kind of option was to go online and buy those goods. Now, fast forward to this year, 2021, a lot of those purchases are really kind of one-time, in nature, right? You're not going to buy another printer. You're not going to buy another exercise bike. And then at the same time, you had retail storefronts reopen, and consumers that have been cooped up for a while, they're spending less time on their couch, browsing through their phones as a recreational hobby. And they're out spending more on sort of experiences, if you will. So we're sort of in this period where I guess what I would call comping the comps. And if you looked at this more on like a 2-year stack basis to smooth some of that out, e-commerce is still growing very healthy, well above underlying retail sales growth. And I would expect, and the data seems to be bearing this out in real time that I'm looking at, that e-commerce will revert back to sort of that mid-teens level growth once we kind of work our way through the comps.
Well, let me flip that on its head then, and let me ask, not only are we, I guess, not peak e-commerce, but from the complete other direction, are there areas where maybe things are accelerating or we think there's more room to run? I guess not just e-commerce, but with digital transformation broadly, the digitization of, I guess, life really.
Yeah, there are several areas of the portfolio where we think that's thematically true. So again, COVID has kind of poured gasoline on the fire, if you will, but I'll walk through some markets where, we think that we're very early on in the secular growth and there's a lot more to come. So to go outside of pure tech, one would be our real estate holdings in cellular towers and the data center REITs. So they're obviously beneficiaries of internet traffic growth. businesses moving online, consumers spending more time online. And you could say that, I'll just kind of snap off some other plays here that benefit from the same theme. Again, kind of within semis, you have things like GPUs. You also have Foundry, which is the outsourced production of semiconductors, internet advertising and content businesses, software as a service or SaaS, and cloud computing. All of those benefit from digitalization and basically just more going online. And then finally, one that I do want to specifically call out is we have several gaming companies in the portfolios, or companies that provide services to gaming companies or are somewhat related. And, shelter in place definitely expanded the market. When people were stuck at home, gaming was one of the outlets. That brought more women into the gaming market. It brought more of the older generations into the gaming market. And that said, we found that it's those users, that increase in users has been really sticky. So Sony has said that the time spent on their PlayStation network is still up 20% prior to pre-COVID. So those customers are sticking around, and with things like metaverse and games just becoming more and more immersive over time, we think gaming is just going to kind of continue to siphon off the entertainment dollars out there, and has a long way to go.
If I can just jump in real quick, from my seat, sort of as the analyst covering e-commerce, I just want to get back to that for a minute and talk my own book, if you don't mind. I think in 5 or 10 years, we'll look back at 2020 and we'll see very clearly that this was the year where online grocery finally hit an inflection point and moved more toward kind of mainstream adoption. And I guess the reason that this is so exciting, at least for those that kind of play in this space, is that the grocery category it's massive, right? It's roughly like 1.5 trillion dollar category. The food and beverage consumables market accounts for about a quarter retail spend, and it's one of the verticals with sort of the lowest, I guess, levels of e-commerce penetration today. So, to the extent that that COVID has catalyzed adoption in this vertical, it unlocks sort of a massive new opportunity in terms of the dollars that are up for grab.
I, as someone with a young child, am very partial to the online grocery delivery, drive up and they'll drive it, wheel it out to your car. I love that. I hope that's here to stay personally. But all right, so with that, we got still a couple more questions. I know we're getting close to the top of the hour, and maybe we'll run a little bit long because we still have a few, I think, compelling points we'd like to share with all of you on some key questions. And the next one here is on the semiconductor shortage. Jake, do one of you guys want to talk about, thoughts around maybe when that's going to end?
Yeah, sure. I'll see if I can pick the pace up here, Jerry. So as semis we mentioned before, we think it's a good microcosm of kind of the broader inflation outlook, if you will. So an example I want to walk through, because we get a lot of questions on this, is auto semiconductors, where the shortage right now is particularly acute. So, just to run through it quick. COVID hit and the auto manufacturers slammed the brakes on production, pun intended. That rippled through the supply chain. They canceled their orders for semiconductors. And what they didn't anticipate, they weren't expecting we were going to see such a quick and violent snapback in demand for vehicle purchases. And that's, again, down to, stimulus checks were hitting people's bank accounts. And with vaccines, they were going to back to work, putting more miles on their cars. But the auto companies found themselves short of semiconductors. They kind of lost their place in line when they canceled those orders. And so we've seen tens of auto plants across the world temporarily shut down. And, I probably don't have to tell the audience, if you drive by a dealer lately and you've looked at what's on the lot, it's that, it's pretty sparse right now. The inventories of vehicles on the lots are at record lows. So how and when does this resolve? So it takes quite a while to bring a semiconductor manufacturing facility or a fab online. It takes a couple of years to build one of those. So we think it's more likely that it's going to get resolved on the demand side than on the supply side. And we think sometime probably next year, if not maybe at worst case scenario, 2023, the market will kind of come back more into supply demand balance. And, again, is with the memory semiconductor example, we're already starting to see that happen with memory. And I think the cycle there was just earlier because it was a work from home beneficiary. and the demand came before the general economic recovery. But we saw waning demand for PCs there, chip supply additions. I think that's just a general preview of what we're going to see in the semi market, particularly because we're increasingly picking up on reports of companies double ordering, so ordering more chips than they need and building inventories. And having lived through a few of these, the way these things, you don't have a ton of visibility, and the way they tend to end is there's a shortage, everybody's freaking out, and then boom, all of a sudden there's an inventory correction out of left field. And I just wouldn't be surprised if sometime 2022, earlier than expected, we get something along those lines.
And then our next question, and I don't know if there's an easy transition to it, but I know this is topical, and I know it's related to everything that's been going on in the news today with, events on Capitol Hill and just scrutiny in general. Jay or Jake, do you guys want to talk a little bit about just government regulation here?
Yeah, I love taking this one, Jerry, because it's an opportunity for us to highlight the differentiated research that we do on behalf of the clients. And I'm really proud of a study I'm going to talk about that came out of my group. So back in the 2018 timeframe, we did this. It was when the regulatory noise around tech was really starting to pick up. We did a 100-page study, which ran through 8 tech companies, 50 plus discrete regulatory cases. And believe it or not, it went back to 1913. So companies like AT&T, Eastman Kodak, IBM were investigated that far back. And so we had a really robust sample size. We were able to identify 3 sale triggers out of that cause underperformance. And we've used that with good success to guide our investment approach in the tech stocks that have regulatory scrutiny since then. For the sake of brevity, I'll just say we're still getting the all clear signal. But on this pie chart here, what I would draw your attention to is, it takes a long time from when the companies are first kind of investigated to when regulations hit. And oftentimes they're just dismissed anyways. But even when there are regulations, you can see the remedies, usually they're kind of moderate or low impact. It's very rare that the regulatory remedies that are decided upon actually impinge on the business so much as for the business to underperform going forward. And it's really important to point out, what are the type of companies that are coming under regulatory scrutiny? It's our strategic profiles. It's companies that have phenomenal market positions, right? They're dominant in their markets. They have pricing power. And, really kind of the power of this study was it told us, look, you want to wait and actually, not shoot first and ask questions later. You want to wait for actual negative remedies. Because if you sell these companies before there's a negative remedy, you're not allowing them kind of the magic of compounding. And they may chug along for another 10, 15, 20 years before there's a negative regulatory outcome and you've forfeited all those gains because you panicked.
Yeah, it's a little bit counterintuitive from that standpoint, which I think makes that insight so powerful and impactful. And just to be clear on the chart as well, that positive, that means that the regulatory remedy actually had a positive impact on the business. Instead of having a negative impact, it had a positive impact, or it had no impact or a low impact, and then the small sleeve of high at 12% being a high impact remedy. All right, and that brings us to our final pre-submitted question. And Jake, I know you have some thoughts that you want to share on what's going on in China, the tech crackdowns, and the private sector crackdowns broadly.
Yeah, thanks. So, the regulatory crackdown in China it's really a great example of when the overview that Jay's referring to determines that we've reached the sell trigger. So, in contrast to what we're seeing with this flare up with some of the bigger US tech platforms, China is just really an entirely different animal. We've seen a pretty rapid and aggressive move to assert much more, state control and regulate in the name of common prosperity. Which allows Xi to basically recast himself as more of a populist leader ahead of his next term. I think there are roughly a dozen crackdowns going on right now simultaneously. But the examples that stick out to us would be what's going on with online tutoring, where these companies were essentially forced to become nonprofits overnight. And then online gaming also sticks out, where regulators are now unbelievably limiting kids to playing no more than 3 hours a week and on kind of specific, days and nights of the week. So, from our view, what we'd say is that investors who are able to sort of, discern what constitutes kind of, run-of-the-mill regulatory noise versus those remedies that truly do have negative implications in the business fundamentals, those investors are going to perform better. Shareholders have been handsomely rewarded over the years for holding Tencent and Alibaba, I guess, despite persistent threats. But, once they see actual negative, I guess, remedies or regulations that impinge upon the business fundamentals, that's sort of the time to get out of the way. And we think that we're seeing that now. So I guess in summary, what I'd say is that, the Chinese tech regulatory environment presents a much different outcome for investors than does the U.S. currently. The U.S. is still, largely in the early stages of what we think will likely be a multi-year period of reviewing these tech companies, and it's kind of far from clear, I guess, what ultimately will be, whether there will be ultimately material negative remedies. But China, again, on the other hand, weaker rule of law and the remedies that have negatively impacted the business fundamentals, they're being laid out overnight.
Yeah, here or abroad, both places, it's something to keep an eye on. I know we're keeping a watchful eye on it and seeing how those factors are going to evolve and their impact on these companies. So with that brings us to the close of our prepared remarks. I know we're at the top of the hour, but we do have a number of questions still in the queue, especially on a couple of tech topics. And we've got the tech team here. So maybe we'll call this like Tech Views After Dark, and we'll stay a little bit long and answer a few more of these questions. So in one additional point I do want to make to all of you before we get to that, as Jay and Jake brace themselves to hear what's going to come in. But we do have a number of insights on a lot of these topics, especially the China one. That's why it's top of mind for me. On our website, under the Markets and Economy section, insights on blockchain, wages and inflation. I know there were questions on economic growth as well. So we encourage you all to take a look at our website. Feel free to subscribe to the Markets and Economy blog, where you can read more on a number of these topics, including bottom-up topics as well. I know there was a question on specific areas of opportunity, and we highlight some of those there. So we encourage you all to take a look and subscribe. And so with that, we have a question here, and I'm sure this is somehow Elon Musk driven, but do we have any thoughts that we'd like to share on autonomous vehicles and self-driving cars?
Yeah, sure. I can take that one, Jerry. So, as mentioned earlier, we own NVIDIA, which we think is one of the beneficiaries of that trend because they're selling chips which play into that market. We also, Google, their Waymo business. I kind of talked about platforms and ability to bolt on revenues long term. That's something that they're not monetizing now, but if you look at kind of private market valuations on that, that could be a real business 5 or 10 years out. And, one of the things that's kind of the next leg of growth for Google as the online advertising market matures. But this is a market that we've been following some time for now, going back to, when there was kind of originally the debate as to, between whether these cars would use just, single camera for sensor, whether they use LiDAR, radar, et cetera. And, maybe it's too inside baseball, but what we found is that, generally they're going to have to kind of use all of those different sensors because, each one of them has its, blind spots, if you will, and they cover for each other. So there's a few other semiconductor companies that at the right price could be interesting plays on this trend. But I will just say that as far as, autonomous vehicles, we're still kind of in the early stages when you consider the various levels there. I think we've seen with Tesla, there have been, various safety incidents. I actually prefer the way Google's trying to go about it and get straight to level 5 where the user doesn't have to participate at all, because I think, we kind of know human nature. It's very difficult to tell people, yeah, you can sit behind the wheel, but you don't have to be involved. But if something pulls out in front of you or if the software goes haywire, at a moment's notice, you need to regain attention and, take over the car. I mean, that's just, people are going to be drinking their coffee or on their phone or whatever, and that's just not going to happen. So I think what we're seeing now is we're kind of in these intermediate phases where it's more about like kind of lane assist or, kind of like automatic braking, and those sort of things are, really kind of be the immediate beneficiaries. And I think we're still quite a ways off from like full level 5 autonomy that everybody's working on. And we kind of almost need like a kind of a clean break to get there, if you will, in my opinion.
What about that related topic of EVs? I feel like they're hand in hand, and sometimes we confuse one for the other. Are you seeing any opportunity there, or any insights you could share to the audience?
Yeah, again, that's one where a lot of the beneficiaries are on the semiconductor side, and so you're stumping me on the exact figures off the top of my head, but if you look at a chart of how many semiconductors are in a vehicle now versus 10 years back or 10 years going forward, and just what the dollar content of that is, I mean, we're getting to the point where it's several $100s of semiconductor content in these vehicles, which is why they're kind of sitting in production, because they're missing chips needed for all these individual systems. So as far as electrification, we think that that's a very strong long-term theme. Again, it's trying to, it's well known. So valuation's been one of the hurdles for us when you think about the individual semiconductor companies that will actually benefit. But I would say, a Taiwan Semiconductor is again, a foundry business that we own. They produce outsourced semiconductors for fabless companies or the companies that design chips and don't have their own production. So that's certainly an increasing growth driver for them as vehicles become more electrified.
Jake, we got a question here on streaming asking, do we see any opportunities around Netflix, Disney, or some of these other emerging competitors that are out there, which is fair to say. It feels like there's a million of them now, but anything on kind of over the top that you could share?
You want to take that one, Jake?
That's all. Yeah, I wish James is in the call.
That's all right. We can skip that then, and we can follow up. That's the benefit of a team-based process, is that we have a number of people who have specific areas of expertise, and so we'll follow up on that. I
mean, that's all right, Jerry. And I'd love to take I know the Facebook is kind of a top of mind too, but I guess what we would say with streaming is, look, kind of the over the top. We think we're in this kind of second phase, if you will, where the majority of scripted or unscripted first run content is going to be developed more simultaneously or exclusive release on the services. And that all the major distributors and content creators have kind of solidified their approach at this point. So we think, to kind of get to brass tacks here, we think there are two winning strategies. So the first is you can own a massive scaled out platform with an incredible breadth of content. You can kind of think of the usual suspects here, like a Netflix or an Amazon Prime, or you can own or develop, IP or intellectual property heavy content with high hit rates, high levels of engagement. Disney Plus, which is one of our positions, immediately comes to mind there.
All right, and let's do one more, if that's okay with you all, because we did get a couple of these and it was pre-submitted as well. And I was going to ask, and we got another one in on the App Store. So if you have any thoughts that you want to share on the App Store as well, I was going to ask about cryptocurrency, but either one, and then maybe we'll wrap it up after that.
Yeah, I'm happy to take the App Store question. I guess the way that I'd frame this is to say that, this is an incredibly, complex regulatory issue with a number of different trade-offs, right? So I think it's easy if you just read the headlines. The court ruling would probably seem negative for the app stores. But if you actually got your hands dirty and went in there and went through the 200 pages of text in the ruling and the decision, there are certainly no shortage of wildcards here. So, I won't go into specifics. I know we're short on time. I guess I would just summarize and say there's a fair amount of uncertainty as to the implementation specifics and sort of the consumer adoption of off-app store payments. I think ultimately What we would say is that we suspect the long term, the App Store's 30% fee is probably heading lower, but probably not as quickly or as dramatically as what many might fear.
And you wanted to talk crypto or blockchain, Jerry, was the next question?
Yeah, I know we got a couple questions previously on blockchain. If you have anything on that, otherwise we can certainly follow up after the call as well.
Yeah, boy, that's a meaty topic. Do you have another hour? So, I mean, look, I crypto, I'll kind of leave that one, alone, because I think, as tech guys, I think what's much more interesting is actually the underpinning of it in the blockchain technology, which is, you could kind of distill it down to a next generation database, which is decentralized. And, the things that are really intriguing to me are like Ethereum, where you can, kind of think of this decentralized, global computer, if you will, where you can program these smart contracts into it. And, we've been doing, I was just, one of my colleagues in the global strategies group, we were having a chat earlier about kind of some of the nuances on this. And we've been holding some sessions within the firm discussing the investment implications here. And they're really fascinating to think about. Thus far, businesses have tend to be kind of centralized, and there's all this discussion about Web 3.0, and instead of Google and Facebook, these kind of centralized monoliths, will you have new companies that spring up that issue blockchain tokens? And Jerry goes and uses the Brave browser, and it gives him 3 cents for spending an hour on, and not even 3 cents, it gives him 3 tokens right on there. And that incentivize Jake to go on and be a developer and further improve the system, right? And it's this idea that we can all, we're all kind of stakeholders, and it's very utopian. It's very early days, but it's something we're thinking about. There's issues with whether it's going to scale or not. There's certainly markets where again, decentralization sounds great from this utopian perfect vision of the world. But look, at the end of the day, a lot of times you need somebody to kind of call the shots and get stuff done. Like I think about like game developing, for example. Are you going to get like a good, decentralized blockchain game if you have, 50,000 people across the world working on it? Or, if you look at the game companies we own, where it's, 50 developers working together, like under a manager and CEO that can point them in a certain unified direction, or you got to get a better project. So it's fascinating to talk about. Again, we could have a whole session on blockchain. Certainly something we're following closely, especially in terms of the disruptive potential.
That Web 3.0 concept, I actually have something in my Read It Later app. I had seen someone come across just a week ago on that. I haven't gotten to it yet, but it's funny to hear that you've also read. Now I feel like I've got to prioritize this thing and learn more about it. And maybe we should also have a full webinar on it. I don't know. At any rate, thank you guys for being here today. And for all those of you who stayed late, we hope this was valuable. We had a plethora of insights. We know it was a quiet quarter, and then it got a little choppy at the end. So we wanted to really share a lot of these insights and get that out there. We will, and I know we got a question on it, we will follow up with the replay of this shortly after today's webinar. So hopefully that can be valuable to you all as well, to either watch again or share with others, which you're more than encouraged to do. So with that, Jay and Jake, thank you guys for being here today. Appreciate it.
Thanks everyone for attending.
And for all of our listeners, thank you for attending today's webinar.